I'll do a quick introduction. We will introduce the education partners, and then we'll get into the meat of the topic today. I am Dayna Wilson, and I ask this every time because I always think it's very interesting. How many people are here for the very first time? Okay, so we've got a lot of groupies here today. That is awesome. Well, welcome newbies. Those of you who raised their hands, hopefully you will come back after today. But I'm Dayna Wilson. I am a seniors real estate specialist with Keller Williams Realty. I've had my license as a realtor here in California since 2006. Prior to that, I was in securities. So I have my securities licenses, 7 and 63. And soon after I got licensed, and determined that residential real estate was the area that I wanted to focus on, I realized I couldn't be everything to everyone, so I decided I wanted to focus on boomers, zoomers, and savvy seniors on the move. And that is what led me to put these seminars on. And for those of you that are here that have been coming for a while, you know that we are, let's see, it's June. This is the anniversary. We're beginning our 7th year. Every single month. Unbelievable, unbelievable. So, you know, we are pleased with when we read our evaluations and when we have conversations with you that you're still finding benefit. We try to mix up the topics, but sometimes we will bring a similar topic back, but we'll have different speakers, and there's always something new to learn, right? And sometimes we hear something 2 years ago, and we hear it again today, and now it's sinking in, or your ears weren't open to it 2 years ago, and now they are. So it's good to keep coming and learning. It's always something different. So I want to just give a quick little shout out to some VIPs, which are our education partners, because without them, we could not continue to bring these for free to you. So I'll just kind of go down the list. We've got Better Days. If you're here, please stand up. Better Days in-home care provider. Mutual of Omaha Reverse Mortgage. They'll be your speakers today. Family Matters. They do moving and hauling and estate liquidation. We've got CareQuest, and I believe they are in the room. CareQuest Placement Services, which is wonderful. Atria Senior Living, Dayna Wilson, Keller Williams Luxury, Carlton Senior Living. I know they have some training this week. The Reutlinger Community. We recently had a bus tour for both the Carltons and the Reutlinger. Who came to those? Anyone in the room that came to those? Okay, great. Oh, good. Yeah. And we have another one coming up. Do you have the flyers out there, Susan? Okay, we don't have the flyers? Oh. The date again was? The 20th. So July 20th, we have our next bus tour, and that will be going to the Kensington and Byron Park. So they are also education partners. Del Monte Group, they are financial advisors. And then Clar's Auction House and Custom Moving and Hauling. There is out right there. I don't think I missed anybody. Perfect. Okay. So thank you to our education partners. It's awesome. We are going to talk about a subject that it's funny because, as you know, sometimes this room is overflowing and we're at maximum capacity. And for some reason, this topic, guys, is like, I think people it's so misunderstood. And that is, pat yourselves on the back because you're here. Because like me, many of you have heard about, reverse mortgages. You see the actors on TV. I think now it's Tom Selleck that's talking about the reverse mortgages. We've had Henry Winkler and all sorts of different people. And, there's newspaper articles, print advertising. And some of you might even know someone who has a reverse mortgage. I do. I have a family member that has one. And there's a strong likelihood that in all the information out there, you've gotten some misinformation, like we tend to do. And that's what concerns most of us. So with that said, it's our goal today to share with you the most current, accurate, and pertinent information about reverse mortgages that are available. And then what to do with that information, of course, is entirely up to you, like everything that you leave here learning about. So we are not here to sell you a reverse mortgage, nor are we here to convince you not to. This series is about empowering and educating and equipping you so that you make the best decisions for yourself in all regards of your life, because it's living by design, not default. So today I'm going to be interviewing with these two wonderful people here that I've known for many, many years, and we will introduce them in a minute. Both of these professionals are local lenders with a depth and breadth of experience and knowledge about this subject. So I'm going to be asking them a series of questions, and then we're going to follow up with your Q&A at the end, and I'm sure you always have some really good questions. So hold the questions till the end, and we'll get those. We always try to save about 15 minutes for those. So write down your questions so you don't forget them. All right, so let's learn something today. Let's learn the latest and greatest about reverse mortgages. I'm going to flip over. Yeah, welcome to my world. All right, here we go. Okay, so first of all, I want to ask, I'll start with Martha and ask for sort of a brief background. Tell us who you are, how you got into what you're doing, what did you do maybe before, how long you've been doing it, so that we know a little bit more about you.
There you go.
I'm Martha Eccles with Mutual of Omaha Reverse Mortgage. For 23 years, I was in branch banking. I was branch manager, and I remember in 2002, a gentleman came in and explained to my staff how reverse mortgages worked. And I had, a lot of experience working with seniors and realizing that a lot of them were struggling. So after the meeting, I took Oliver outside and I said, Oliver, I think I'm interested in this program. I might want to participate. And he threw up his hands and he said, I don't even know if it works. I just started. But 2 years later, he was so busy that he asked me to join him in 2004. And so I've been doing this 18 years. I love it. I love it because I get to hear people's stories, where they have been and their goals on where they want to be in the later years in life, and it's really rewarding to help them meet those goals. So, and I've known Marty for a long, long time and really enjoy working with him.
Great. Well, Marty, tell us about you.
Okay, well, Marty Apple, I'm Mutual Omaha Mortgage, and I've been in the reverse mortgage business for 22 years, a little bit more than you, but not much. But I got into it too. I was in the regular mortgage business, but we started a branch of this when I was with a private broker, and started to really enjoy meeting older homeowners and helping them get some relief. Many of them, as they are today, retirement funds are dwindling. Stock market problems are causing portfolios to go down. All of those factors combined, plus home values have grown and they continue to grow. But it's a good way to help older homeowners get some cash out of their home and to supplement their retirement income. So it's been a fun ride, and just last week I closed one loan, and a couple they were in pretty dire straits too. But was able to use. Did not have a mortgage on their property, and they told me after they got their money, it was kind of like somebody was sitting on their shoulder and helping them go through this. And that gives you the good feeling, that you're doing something right. And in all the years, I have not had anybody complain about what they've done. You know, the decision that they made is one that was very positive for them. And you know, all of you here today, you know, took a major step, you know, to come in and at least learn about what an alternative would be for you if you got a reverse mortgage, and maybe to coming in and not listening to financial advisors or other people, neighbors and friends and stuff, and say, don't do this. I hope that when you leave today, you'll have a much better feeling about what you can do.
I have a question, Marty, because you just brought this to my mind. I know that there's very few lenders in the industry that are offering reverse mortgages, so I wanted to ask you what your thoughts are about why, like the normal, you know, your B of A's and your Wells Fargo's used to offer reverse mortgages, and they do not anymore. So that's my first question. And my second question is, why do so many financial advisors poo-poo this? I know some really embrace it and they understand that it is yet another tool to be used, but some really, oh no, stay away from that. So I don't know which one of you wants to answer that or not, but this is just my curiosity.
I'll take the financial.
Okay, why do financial advisors poo-poo this?
Well, there's two kinds of financial planners I've learned over the years. There's the type of financial planner that says, he who dies with the most money wins. And then there are financial planners that really take the time to learn and understand what your goals are, and if the resources that you've saved over those years aren't enough to help you achieve what you've looked forward to all these years, then using some of your home equity to make that happen is becoming a much more popular conversation with financial planners. To be honest, as the baby boomers retire and the younger generations, there's a lot of people that just aren't equipped for the longevity that we may have. You know, someone works for 40 years and they retire in their early 60s, but they live another 40 years. It's really hard to imagine just how much they had to save to live comfortably.
Okay, thank you. And what about, why did the banks get out of this product?
Well, that's in 2008 when we had the financial crisis back then. The Federal Reserve started tightening up some of the rules for banks that were offering the reverse mortgage, and they had it was costing them, the major banks, it was costing them a lot more money, and they were looking for another profit center. And within 6 months, Wells Fargo, Bank of America, and MetLife, the three major banks, big banks that were offering this, all of them got out of the business, and you know, that was really unfortunate. But that's what caused the problem. And MetLife just 5-6 years ago got into the business because they saw this as an offering that.
Mutual of Omaha.
Mutual of Omaha.
Yeah.
Yeah. Thank you. But Mutual of Omaha got into the business, and the company that we were with, that Martha and I were with, became part of Mutual of Omaha, and it's been a great relationship. I mean, it's a phenomenal company, and it's just the things that they can do and what they offer us as being out in the field, so to speak. You know, we've got the tools, we got better tools to work with, and they're just phenomenal. So,
Awesome, thank you.
That's it.
So I'm going to ask Martha the first part of this question, which is, what is a reverse mortgage? Let's just unpack this for everybody.
So a reverse mortgage is just a mortgage with a deferred payment option. So a person gets their monthly mortgage statement, they decide whether they want to make a payment or not that month. They can make a payment of any amount. If they don't make a payment, the interest is just added to their loan. So if they do make a payment, then it's not added. Also, you have to be 62 years old for the FHA, or that's Federal Housing Administration insured reverse mortgage. And that's what the most popular program. So we're going to talk primarily about the FHA insured home equity conversion mortgage. And it's administered by the Department of Housing and Urban Development. So what we're sharing with you today is a government-insured program. You can visit the HUD.gov website, see for yourself more details. So the name of the program is the Home Equity Conversion Mortgage. We call it a HECM, but primarily when you hear the term reverse mortgage, that's what it is. As with any mortgage, you still have to pay your property taxes and your insurance and maintain your home because you're still the homeowner. The bank doesn't own the home. Just like if you have a mortgage or a home equity line of credit, the bank is not the lender. But I did want to applaud you for coming out today to learn more about this program. Many people are skeptical of reverse mortgages, and for good reason. Because in the 80s, before FHA got involved, there were reverse mortgages that were sold, a lot of them in the Bay Area, where the lender actually went on title with the homeowner. And over the years, as the loan grew and the home value grew, if you owned a home in the 80s in the Bay Area, your home value more than doubled easily. So when those loans came due, the lender would be entitled to be repaid what was borrowed, plus interest, plus 50% of the equity, of the appreciation. So that's really an equity share feature, not to be confused with a reverse mortgage. So under President Reagan in 1989, they designed the home equity conversion mortgage, and the lender is not allowed to be on the title. So the guidelines from FHA are very strict, and so for the last 30 years, these reverse mortgages have not, the bank does not own the home, but I'm sure if you ask friends or neighbors, they might think that's the first thing, first misconception about a reverse mortgage.
So do you want me to go on to the
Yes.
next slide? Okay.
Then, so one more? Yeah. So what's the difference? Is the FHA is a non-recourse loan. That means that the lender is not allowed to put this loan on your credit report. They're not allowed to, if you ended up living there for a long, long time and you ended up owing more than what the house was worth, the lender is not allowed to go after you or your assets or your income or your heirs for any shortfall. So any deficit, whereas in a typical mortgage that might be considered a short sale, in this case, FHA mortgage insurance is going to step back in and pay the shortfall. And that's why the lender doesn't need to be on title, and we're not allowed to be on title.
Mm-hmm. Excellent. Thank you. And so we're getting to know what it is, and I wanted to ask Marty, how is it most often used?
Well, typically, a lot of our borrowers have a current mortgage on their home, and this is one element we can pay off that mortgage that exists and roll that into the reverse mortgage. Then that would be sort of a lump sum at closing. You can also use this if you purchase a home. You can use the reverse mortgage to pay for part of that purchase price. You could set it up to receive funds on a monthly basis if you want to do that to help pay for any in-home care. Or to help your monthly budget if that's the way you want to work, the process. The third item is to set it up with a line of credit. And many people can pay off their existing mortgages and then would use the balance of the reverse mortgage benefit to establish a line of credit. And then if you keep it in a line of credit account, that line of credit will grow for you. It's not interest because None of this is taxable, but it would increase your line of credit balance on a monthly basis. And today, with interest rates the way they are, it's a pretty significant growth that you can get any money that you would have in that particular account. So that's basically the three major areas for using that.
Okay. So do you have an example you could share of a client using a reverse mortgage to eliminate their monthly mortgage payment?
Yeah, maybe a couple of them. I had a client, Charles, was he lost his wife and was then able to use some of his funds to get a reverse mortgage, to pay off some of his existing bills, but also he had no mortgage, so he did have a mortgage that was costing him $2,200 a month, and he was able to then convert that existing mortgage into a reverse mortgage, and that gave him, some pretty good liquidity on a monthly basis of $2,200 a month. So that increased his cash flow significantly. But he was then able to take that and be able to upgrade his kitchen and do some other work around the house to improve it. Then would have a line of credit of $60,000 that he had left over to be able to use for any other needs. But that tied into his what used to be a mortgage payment, gave him some pretty significant income. For his life. Another couple that was able to, Norma and Patrick, was able to then get some reverse mortgage to have some tax-free income. Again, none of this money is taxable, but they were able to get some money each month to pay for Norma's home care. She was declining and having to have some care, have some early stages of dementia, and this gave Patrick the ability to have some in-home care and have some money over to pay for her care. It's interesting how relieved people are when they get the reverse mortgage, how they don't have that burden of trying to figure out where they're going to get the money to pay for some of this care. And today, home care is getting pretty expensive, and that's really creating a significant burden for homeowners who choose to stay at home and then get the care that they need on a daily basis. So. Those are a couple of examples, but you have some good positive steps too. I've got one client that is getting a reverse mortgage now to make an investment in some property that he and a partner are going to have to be able to develop into 4 homes, subdivide that lot. So, some good positive things that can happen too. Positive things like going on trips or taking care of their grandkids. Those kinds of things can help too, because there's no restrictions on the reverse mortgage. Only thing, you can't use it to buy an annuity, but other than that, you've got free reign to use the money as you see fit.
Oh, that's awesome. I want to make sure we're on the right slide here. Do you want to come?
Go a couple forward.
Okay.
There we go. Okay.
There?
I think that was the one he just explained. So there is another way to use a reverse mortgage. It's to purchase your home. So oftentimes people will be in a home that, like Dayna says, it's either too big, too much work, too expensive, too many memories, and they're ready to buy another home or live somewhere else, maybe closer to their children, or maybe, for example, Rossmore with all the amenities. But when they sell their home, they realize that that is probably their biggest nest egg, and they would like to put some of that money into their investments so they can live off of it and enjoy it in the future. So when they take the remaining proceeds to go buy a home, they're sometimes disappointed that they can't get the home they really love, something that they've worked for all these years. They've kind of dreamed that, okay, when I retire, I want to have this kind of lifestyle. And with just paying all cash, maybe they can't get the home that they're hoping to live in. Or maybe during retirement, they don't want to get a regular mortgage and take on a monthly payment because that's kind of the opposite of what their plan was during retirement. So we can help people buy their home with a one-time down payment, and then each month they get their mortgage statement and they can choose to make a payment or not. And I kind of have an example on the next page of a couple who sold their Lafayette home. And after paying off their mortgage, they had about $1 million left. But this was their big chance to take some of that money. For this particular couple, they did not have a long-term care policy, and they knew that that was it was important to plan for long-term care. And at their age, at 75, it was going to be really expensive to buy a long-term care policy, or perhaps they wouldn't even qualify. So in this respect, they put...
Talk a little farther away.
Farther away. Thank you. I'm like blowing you out. So they bought a home in Rossmore. How many of you have ever been in Rossmore? Yeah? Okay. So they bought $1 million home, a beautiful home, and they put down $600. And that meant they still had $400 left in their nest egg for them to enjoy. And especially, some communities, especially Rossmore, has a homeowners association dues, which covers a bunch of amenities, but, paying $1,000 a month could be a little more difficult, but they have this nest egg. And if they don't use that $400,000, that can pass on to their children. So I think Dayna and I have worked with some of your clients in a similar manner.
Yeah, we had it's funny, sometimes I basically, my clients come from either they're repeating clients or they're referred, and often they're being referred from their trusted advisors, their financial advisors, their attorneys, their CPAs. And in this case, a financial advisor called and he said, actually, a lender and a financial advisor both told them you need to talk to Dayna. And I met them. They also were living in Lafayette, off of Release Valley Road, and they were living, they had a beautiful lifestyle. I mean, they were going on trips and very interesting, active people. But yet, we had to have a tough conversation because they admitted we are basically running out of money. And according to our financial advisor, we will be, we'll be out of money in about 9 months.
Wow.
And so that was,
Never wanted to hear that.
that's sort of a wake-up call. Sometimes our wake-up call is health-related, right, or a life change. But in this case, it was maybe a little bit of denial because they'd probably seen that coming down the way for a while. And so, we talked about the different options, and that's when I, really asked them, well, what are your goals? What are your plans? And they said, well, we don't need this huge house. We don't need to be living on this steep driveway. They had a really long, steep driveway. They'd both been falling, and they said, I think it's time, as much as we love this place, it had views, it was fabulous. We think it's time to sell the home. And get some of this equity out of the home, and they wanted to buy something that was lower maintenance, easier to live in, and less expensive. In this case, interestingly enough, they ended up buying in Crockett, which is quite a cute little interesting community. But so we helped them sell their home, turn around, and then they purchased with a reverse mortgage, and they could, as Martha said, put the difference in the bank to live off of, which was great. Was there anything else you want to add with that scenario? No, okay. So let's go on to how much can you borrow? How much can you borrow? And I don't know who wants to take that. Okay.
So the amount a person can borrow is going to be based on their age, the home value, and the current interest rate environment. So with the FHA insured reverse mortgage, FHA guarantees that in the future they'll pay any shortfall. So they have a maximum home value that they'll look at of $1,089,300. So for a home that's valued at that point or more, FHA is just going to lend a percentage of that based on one's age. So if someone's 62, they get to borrow, for example, maybe $344,000. If someone's 92, they'd get to borrow $668,000. And it doesn't take too much to figure out why that is. Someone 62 may live there 30 or 40 years, so they get to borrow less at the beginning. But FHA structures it because they want to ensure that you do have equity in the future, so the insurance fund does not have to come in and pay the shortfall. So years ago, 2011, 12, FHA had much higher loan to values. But then they realized, that that was leaving, people could borrow a lot more money, like 75% of what their house is worth. And FHA realized that gave them less equity in the end, so they've backed it down over time. So when I talk about interest rates, on an FHA insured reverse mortgage, whether it's a fixed rate or adjustable rate, it's going to be about 1% more than a traditional mortgage. So yesterday I heard a mortgage officer say that the 30-year fixed for that example was 7 1/8, and our forever fixed is 7.99%. Now, the interest rates are higher on a reverse mortgage because we don't know if we're going to be paid in 2 years or 22 years. With a traditional mortgage, the lender collects money from the borrower every month, and they go invest that money, and they earn money on that money. So that's why the rates are a little less. But I'm also going to just briefly touch on what's called a jumbo reverse mortgage. You may have heard of that. It has the same consumer protections, but it does not have FHA insurance. So that means that in the future, if for some reason the homeowner owed more than what the house is worth, the lender would actually take a loss. So, it's a little harder to get investors to sign up for a loan. They don't know when they're going to pay back, get repaid, or how much equity they'll have in the end, or their liabilities. So with the non-FHA insured, the interest rates are 3 to 4% more than a conventional 30-year fixed. But in some cases, you'll see it does allow a person to borrow more. Or if someone has like a $5 million home, they could probably borrow $2 million, but it's going to be at a higher rate.
Okay, awesome. So next slide is, what are the fees associated with a reverse mortgage?
So there's two kinds of fees. There's fees that are out of your pocket, and that's for the FHA insured product, and this is going to vary from lender to lender. Some lenders make you pay for the full appraisal, which is around $600 up front. We collect $300 as an appraisal deposit, and the rest is financed with the loan. And there's also the home safe or the jumbo reverse mortgage, which you would have to pay about $800 for the appraisal. The other closing costs are financed with the loan. What does that mean? It means you're not paying it now, but when we start the loan, we'll pay out those items. It'll be added to the loan balance. And years from now, when your home is sold, that would be repaid as well. So the typical third-party closing costs are very similar to what you'd have with a traditional mortgage: your title insurance, your escrow costs, your recording, etc. And that's going to depend on the home's value. The other is the loan origination fee, or if you've had traditional mortgages, it's similar to points. And then the third is, if you're doing the FHA insured reverse mortgage, you have to pay insurance premiums, just like every other type of insurance benefit that you get, but that's financed with the loan. So at the beginning of the loan, we write a check and we send that to FHA so you could participate in the program. And how much those figures are depend on several factors. So you can reach out to us, our material's all back there, and we can run a scenario for you and show you, okay, option A, option B, here's the cost.
Perfect. All right. So, Marty, what is this required counseling process like? I happen to have gone through it with a family member, so I've experienced it firsthand, but why don't you kind of walk us through what some of the consumer protections are, if you will?
Okay. Well, you know, it's a good protection for consumers to get the facts from somebody else other than maybe the reverse mortgage specialist that they're working with. And this is just to assure that they're getting all the facts correctly, that nobody's trying to lead them astray or whatever, but we try to go through that as much as possible. But the requirement for counseling is kind of the beginning. After we make a presentation and go through all the proposal, we give the clients a list of counseling agencies that they would contact, one or more of them. We can't attend or help them with any of that. They have to do this. You have to do this on your own. And it costs about $150 to have that counseling. And it's an over the phone. Typically, it's over the phone. There's some places where you can get face-to-face counseling, but it's kind of slim. They're just not offering that
Since the
very much.
pandemic,
Yeah,
they don't
right.
really do that
Yeah, since the
anymore.
pandemic. But 1 hour plus counseling session, depending on the questions that you would have. Once you complete that, they give you a certificate that says you've completed it, and that's basically our authority then to submit the application, so we can underwrite it and complete that. There is also, as with any refinance loan, like for FHA, there's a 3-day right of rescission. So we sign all the documents at closing, and then you have to wait 3 days to get the money. So that's with the non-recourse feature as well. It's not going to be a requirement that you're going to be paying any more than at the end. Your heirs or estate will not be paying any more than the value of the property. So there's some pamphlets. We talked about buying the home. There's a small one and a large one back on the back table that gives you some of the facts and examples of what a home purchase might be if you're considering something like that. There's also the National Council on Aging puts out a booklet that we're required to provide you that talks about using your home to stay at home, just to give you some alternatives, to make sure that you are looking at all the factors. And then the Bureau of Consumer Financial Protection has another booklet too, dealing specifically with reverse mortgages, and that's also on the back table. But just to explain what your protections are, and make sure that you understand that. So all of these too, we provide when you would talk to us and we give you a proposal to understand what the true facts are. So those are available. So.
Awesome, thank you. I know, we're getting into the weeds today, aren't we? A lot of details, but hopefully you'll leave with sort of the high-level big nuggets of what this is and what this is not. But we are going to ask Marty to talk about the myths and misconceptions. We touched on this a little bit in the beginning. When I used to talk about reverse mortgages, my slide had gnomes on it because it was a myth, right? We don't really believe in gnomes, do we? I hope not. Anyway, all right, Marty, tell us what some of the myths are.
I guess, Dayna, probably one of the biggest myths is that the bank owns the home. That's going to be that's something that's totally wrong. The mortgage is a document that basically puts a lien on the property, and that lien would stay on property until you dispose of the property. So, but just like a regular mortgage, the only thing is that you're not making a monthly mortgage payment. So that's the significant difference between that. Another myth is that your heirs have to take up money and pay off the loan. That's not the case. Being a non-recourse loan as well, there's no, and all you do is your heirs or your estate would pay off the mortgage at the end when you leave the home. That's when it becomes due. And you do not have to pay any additional fees, or it's just, there's no prepayment penalty to pay off the loan. So another misconception is that there's no way out, that once you get the reverse mortgage, you're stuck with it. That's not the case. You can pay off the reverse mortgage at any time you feel like it. If you win the lottery, you can take this to pay off the loan. But there's no, you can change it. You can refinance the reverse mortgage as home values continue to increase. You have some additional cash available. FHA has raised the loan limit, and they do that every year. They adjust the loan limit, and that's all based upon the regular mortgage market as well. It's a formula that FHA uses to make that calculation. That's why we have that strange figures of $1,089,300. But it's also, people think that there's an equity sharing and that that the lender participates in the growth in your equity, and they have to take a share of that. That's not the case. It used to be, when it all first started, but after FHA created the HECM, that basically eliminated all that equity sharing stuff. Again, there's no prepayment penalties, and it's questions about it being inflexible. I mentioned earlier the 3 different ways that you can take the money, and that still applies. That you can create whatever, and you can make changes if you've got a line of credit that's you're getting a monthly amount. You want to change that to put it in the line of credit, you can do that as well. So any of those adjustments, a very minor cost, $35 I think or something to make those changes, but it's a very flexible product.
Awesome.
Okay.
So along that same line, let's talk about the 4 nevers, Marty. What are the 4 nevers?
Yeah.
Never, ever.
Never ever, yeah, never ever. But the other misconception is that the bank owns the home. Well, that's not the case. You will never lose title to your property. That always stays in force, and it's just when the title is put together, it's a lien on the property. So, and you never owe more than the house is worth. We've had some cases in some areas of the country too, where even in outside of the Bay Area, where like 2008, we had a loss in property values. Some of the properties did go down in value, and so the loans had come up where they've been used, taken all the money that they could, but FHA stepped in and took over to pay for those deficiencies that were available, you never make a monthly mortgage payment. You have to pay your taxes and insurance, but you do not pay any mortgage payment at all, so principal or interest. And you never have to move. Once you're in the property, You've got a reverse mortgage. If you use all the money that's available in your reverse mortgage, the reverse mortgage stays in force as long as you live in the property. So that's a good protection for you as well. So you never lose your home. So,
Awesome, thank you.
okay.
Can we back up to this?
Yeah, you want to go
When is
back
the
one?
loan due? When is the loan balance due?
Oh, was
Near
there a
the
slide
top.
for that?
Yeah, it's kind of like the third or fourth one.
Oh,
Yeah. And like Marty was saying, you never have to move. And that's because the loan is in place until you decide if you're going to sell your house, or if you move out permanently, the loan is due. Or if you pass away, then your heirs have to repay the loan within 6 months. In most cases, if there's multiple children, they're going to want to sell that house anyway. The loan gets repaid and the estate gets to inherit the remaining equity. Or if none of that happens, then your loan is not due till your 150th birthday. So it's the kind of loan that you don't have to worry that one day something's going to happen and you have to sell your house or move out. Now, if you were to get, I like to use the example, if you are on a cruise and you and your husband are dancing and you both fall and break a hip and you both have to go to a care facility, well, as long as somebody comes back home within 12 months, then there's no effect on your loan. And when we talk about the house has to be your primary residence, means you have to live there at least 6 months and 1 day a year, each year. So if you have a home in Palm Springs or you like to go to Spain, all of those are okay. It's just it has to be your primary residence.
Awesome, awesome.
Thanks, Dee.
I do want to bring up something because it's a real thing, and you know, because you've been coming to these for a while, that we talk about the nitty-gritty, we talk about the good and the bad, and we try to give you the truth and the facts. So my family member has been living at home, has in-home care, and in-home care is quite expensive. And I've shared this with you before, but she pays over $24,000 a month in an in-home care. So this particular family member has a reverse mortgage, and it will be used up in about a year. So that is another time when somebody, it's not the lender that is going to make her sell her home. It is the fact that she needs care, and if she can no longer pay for care, she's going to have to move. So that is one other thing. It's a real thing, and I don't know if you have any comments about that, but it is what it is, right?
Yeah, just, I think Marty said earlier that his clients haven't had regrets. I think their biggest regret is maybe how they spent the money. I heard of someone one time, the kids were upset because the dad had gambled that money away.
yeah, right.
So it's not so much that the loan has been the problem, it's how they manage their money.
Yeah.
So we ask a lot of questions. We help work through it with a budget so we can see, is this really sustainable? Is this something that's going to be comfortable? If we did the reverse mortgage and eliminate their mortgage payment, but next month they can't pay their homeowner's insurance, then we haven't done them a favor. So FHA has some strict guidelines on how we can show that this loan is sustainable. But even then, she gets to live in her home. She gets to enjoy it. In the end, when the home is sold, if there's equity, that's what they can use for their next adventure. And we always prepare an annual projections worksheet based on whatever your assumptions are and how the money would be spent, and we'll calculate how much money we think you'll have in equity up to your 99th birthday.
So we're going to talk about when you're ready to sell your home, because I know some people, they'll call me and they say, well, honey, I think we're finally ready to do this, but we have a reverse mortgage, so we have no idea what that's going to mean when we sell the home. So we're going to talk about that now.
So you would just sell your home like any other transaction. You'd find your favorite real estate agent. You'd get an analysis of what your house is worth. You would show the title company your mortgage statement because they have to request a payoff demand. And your mortgage statement is current every month, so you'll know how much you owe. Then the house is sold, and at the end of escrow, you or your estate ends up with a check But remember, if there's no equity left in the home, like if we see another 2008, which we don't see coming up, but if that were to happen and there were no equity left in their home, there would be no deficit that's passed on to the children. And in that case, if the loan balance exceeded the home's value, the family could literally just sign over the home in a deed in lieu of foreclosure, so there's no foreclosure. They can sweep the property clear, and then FHA will come back and sell that property later. But there's never a chance that they're going to have to bring money out of pocket because mom had a reverse mortgage.
And we're working on that right now. I had an ex-sorority sister from Cal Berkeley call, and her mom has a lovely home, and it's that exact situation. I think they talked to you about that.
Yeah, her loan was done many years ago, and it was where you could borrow 75% at the home's value. And so now, 15 years later, they owe more than what the house is worth. The husband passed away. The lady moved into a great care place, and the daughter's signing for the mom in lieu of foreclosure. They're just handing the keys over, and eventually that lender or FHA will come back and sell the property.
Yeah. Okay, anything else we need to know about selling your home?
Nope. I think
Okay.
I've said it 12 times.
Okay.
No deficit.
Okay, so, I think when you're working with anyone, do you want to say something? Yeah, oh, we're not at the Q&A yet, Missy.
Sorry. We'll come back to it.
Hold that thought. All right. So I think when you're choosing a financial advisor or a lender, reverse lender, whatever, you want someone local, right? But I wanted them to address, what should you look for if you're going to work with a reverse mortgage lender? So who wants to answer that?
Yeah, I can start that process.
Okay,
Dana,
maybe
but,
both of you can chime in.
The main thing you want to look for is somebody that you know and trust, that you feel like can help you with this. It's a pretty significant transaction that you want to have that communication back and forth to make sure that you have all your questions answered and is able to handle it in the right way. And also make sure that they're members of the National Reverse Mortgage Lenders Association. That is another element in the reverse mortgage process where you can deal with somebody who has the ethical standards that we call it NRMLA, that the National Reverse Mortgage Lenders Association adopts to make sure that we're taking care of our clients.
And not every lender will become or is a member of NRMLA, National Reverse Mortgage Lenders Association, because they have to sign the ethics in advertising, ethics in working with seniors and putting their goals first.
Yeah, and if you can meet face-to-face with somebody, a specialist, that would be best. Just at the kitchen table is a good spot for the discussion. We dealt with COVID for the last 2 years, and we're getting back into the process of meeting people face-to-face. And that's much more comfortable for us, as well as much more comfortable for you to be able to have that face-to-face conversation.
I don't know about you, but every time I have to call 800 number, I'm just like, okay, I got my notepad, I'm set.
Yeah.
So there's a lot of advertising on TV, but it is a little different. I mean, not that they're not trustworthy, but it's a little different if you're dealing long distance and have to FedEx your information there or fax it to them.
Yep, that's right. Then, find somebody who's experienced is helpful. With our 18 to 22 years experience here, we've covered a lot of the bases. So, and seen a lot of the things that we need to pay attention to. So each one of you have a separate story, and hopefully we can meet with that and help answer that story. So to help you out. Be sure and ask a lot of questions. It's the rest of your life, and you're making a commitment, a financial commitment on your property. So be sure and make sure you understand, what you're getting into. Also, if you could include your family, I've had some clients that don't want to tell their kids what they're doing because they're going to talk them out of it, but it's significant that you include any of the decision makers that are going to help you with this. So whether it's counselors, your financial planner, or anybody else that's going to help you make that decision. Financial planners are becoming more and more attuned to the reverse mortgage, so and also the national FINRA, FINRA, has been also has taken the block off of reverse mortgages, and so financial planners now have the capability to get this product that's endorsed by FINRA. So, but include everybody else that can help you with that if you need that.
And I love working with the family. I mean, sometimes homeowners will tell me, I don't want my son, the one who lives at home and does the pay-per-view constantly, to be a part of this conversation. But in most point, they're a little nervous about having their kids come into the conversation. But when we lay it all on the table, and you really understand what the parents' needs are, maybe they're living on $1,800 a month, or their fridge is a little empty, or mom is lonely in her house and she'd rather be living somewhere with a group of people like her. Once the kids understand what mom's goals are or dad's goals are, then if the reverse mortgage is not the best option for them, then it's on the kids to help their parents. And over these 18 years, I have had 2 situations where the children both said, "Hey, Mom, I'll pay the $1,800 a month you're short. We didn't realize it." And I think that's an awesome solution. But in most cases, the kids are, they have their own kids and their own financial responsibility, and they're working still, so it's hard for them to take time off work to go provide the care that they would like to care for their parents. So a lot of times the adult children are out there seeking advice and looking for solutions to help their parents live comfortably now and be prepared for whatever's coming. So, and we really like to work with your financial advisor and make sure that this loan is incorporated with your full financial plan, right?
Mm-hmm. Excellent. So is there anything that I have failed to ask either of you that you want to make sure we share today before we dig into their questions?
I think we've pretty much hit all the bases, Dayna.
All right. Yeah?
Some of the fact, there's
we went deep today.
you're always going to have a situation that you haven't handled before that would come up, but I think we've covered most of them.
Okay.
Yeah.
All right.
I appreciate you having us here. It's been great.
Of course.
Just your being here, is evidence that, people want to learn, want to know, and want to get the facts. And that's what we're here to do. So.
Well, yeah. I mean, this is, again, my family member used this. We had to take, some pine trees down. That's $15,000.
Jeez.
We had to install a chairlift. That was $12,000. The kitchen, one of the 2 ovens wasn't working anymore. 2 of the 4 burners weren't. I mean, it was pretty sad. The kitchen needed to be updated so it could actually work right. And then in-home care. So this is a very important tool. It's not right for everyone. You want to talk to your trusted advisors about it, but it's an important tool to allow people to stay put. And I thought having this topic this month and then next month is we're staying put, AKA, we're not moving. How do we age in place at our home is a good segue because, how do you afford to stay in your home? What does that entail? How are you going to pay for that? And so let's dig into your questions because, again, we went into the details, but there's no dumb questions. So who has a question that we can ask Marty and Martha? All right. I'll start in the front and work my way back.
I wonder if you could tell us what the differences are between a reverse mortgage and just a regular line of credit through a bank as
Good
far
question.
as
Good
interest rate you pay, fees involved, that kind of stuff.
Yeah, good. That's a great question. We should have had it here. So with a home equity line of credit that you might be able to get at your credit union and some banks, it's a nice way to use some of your equity for whatever it is that you want to do. But you do have a monthly payment associated with that. Whatever you borrow, you have to pay each month. With the reverse mortgage, you don't have to make that payment. Also, with the home equity lines of credit, they're generally revolving for 10 years, meaning you can borrow and pay back up to 10 years. And at the end of 10 years, whatever you owe, they don't necessarily let you borrow anymore, but then they set the payments up so that you're paying it off over a longer period of time. So it's great for short-term needs, but if you're concerned, for example, if you borrowed $50,000 and then you get to a point where you can't borrow anymore and you now have bigger payments with interest and principal, it could be a little hard to do that. But with a home equity line of credit, most of the banks will do that for you with no closing cost. I think if you close it in 3 years, there may be a prepayment penalty. But it's a nice, in fact, my next door neighbor's father's 95 and has severe health issues where he might only be there for another 6 months. So I'm like, a home equity line of credit would probably be fine.
What's the interest rate difference? Because you said for a reverse mortgage, it's another 2%.
Reverse mortgages are about 1% more than a home equity line of credit. So home equities are probably in the 6s, and ours are in the mid-7s to low 7s. I know that's a huge number, but 12 months ago we said, our rates are probably 2.
Yep,
But
2 or 3%.
the rates, we have both a fixed rate loan, which is a one-time payout, more like a 30-year fixed rate mortgage that you'd get, or one and done, or with the line of credit, where you can borrow what you need when you need it. The rate will adjust based on the cost of money or T-bills. And right now, we've seen an increase where we came off of, 8 years at very, very low rates. Again, as the interest rate adjusts, it doesn't affect the homeowner because they don't have to make a payment, but it will impact how much equity is left in the end for their estate or for them when they sell their house.
I
Thank
think
you
the
for that
biggest
great
difference, Suzanne, is I've had people say, well, I'll just go to the bank first and look into a home equity line of credit. And then they really realize they can't afford to pay that monthly bill with the income they're living off of. And there's no monthly payment with a reverse. So I think, to me, that's the biggie, right?
Yeah, and
To
sometimes
pay or not to pay.
Yep.
and
right?
home equity would be based on your income, and sometimes a person on a fixed retirement income may not qualify for very much, whereas a reverse mortgage, maybe they could get 300.
Perfect.
Yes.
Okay. Oh,
Wow.
This probably isn't going to go on for 20 years.
Then that might be a great option.
and maybe, talk to Martha afterwards about this. Talk to Martha afterwards, maybe, if you want to learn more. Sharon, what is your question?
Actually, two. If you have some kind of catastrophic incident happen to your house and it's destroyed, how is that connected or treated when you have a reverse mortgage? And does the reverse mortgage have any effect on any trust that you might have established?
I'll take the insurance. You could do the trust. How about that?
What's that?
You can answer her question about the trust, and I'll
Okay.
do the insurance.
Okay, yeah. You can put if you have a trust right now, you can just, the reverse mortgage will go in and just roll over into the trust, no problem. If you want to get a trust later, you haven't done it yet, you can get the reverse mortgage, but you have to make sure you contact the lender to make sure that they can accommodate the trust as you go through that. But most of them are, if it's a revocable trust, most of them have the provisions to be able to encumber the property into the trust.
And catastrophic events, Martha.
So with anytime you own a home and have a mortgage, the lender requires you have homeowners insurance. And it's the same whether it's a traditional or a reverse mortgage or home equity line of credit. So if there was something catastrophic, your insurance would come and pay it, okay? And so earthquake is going to be a separate topic, right? So your insurance would be, if you have earthquake insurance, then they would rebuild it. Most of us probably don't. But if your house is destroyed and you don't want to live there anymore, then you don't have to pay the shortfall, right? So let me back up. So for example, Hurricane Katrina. When Hurricane Katrina hit New Orleans, many homeowners decided, that's it. I no longer want to live here. I'm out. Maybe ours would be that we're out of California if earthquake season happens. So if they have a reverse mortgage, they would simply sign the home over to the lender, and the lender and their loan would be paid off, basically. They can deed the home over to the lender in lieu of foreclosure. Now, if your house is worth $0 and you owe a $400,000 mortgage, remember that the deficit is not passed on to you. But if you, just because you have a reverse mortgage, it doesn't mean we're going to pay to get your house rebuilt. Is that kind of what we're asking? Okay.
That would be the same with any loan,
Yeah.
right? A regular forward mortgage.
Yeah, we call it
Is that what-
forward.
Yeah, no, they call it forward and reverse. Anyway, any other, okay? Carol?
Is the interest going to be fixed or variable?
Well, if you can have a fixed rate loan. There's a one-time payment, the lump sum that you would get at the beginning of the loan, and no more. There's generally, the fixed rate is a lot less than what the variable rate would be. Most of our clients get the adjustable rate because they can keep that money in the line of credit and take it out as you need it, where with a fixed rate, you get all that cash up front.
I think what you said was the fixed rate, the amount you can borrow with the fixed rate is usually less than with a line of credit. Okay.
Yeah,
But
right.
the interest rate on a fixed rate is naturally going to be more than on an adjustable rate. Okay.
I meant for the reverse mortgage. You pick your rate.
Yes.
Yes, yes. So but the adjustable that you would get if you have a line of credit or be able to keep that money in a line of credit, that rate will adjust as the market will adjust. But you get a lot more money because that's available to you. All the FHA loans too, there's a requirement that you don't get all of the money at the beginning of the loan. You get about 60% of the money that's available, and then after you reach your 1-year anniversary for the loan, you get the balance. So not all of it is available at the beginning, unless you have obligations that would have the amount of money would have to be paid at closing of the loan, so you could get a little bit more.
Is that a consumer protection?
Yeah, they did. FHA, I guess in 2015, decided they didn't want people to go do a big reverse mortgage and then invest all that money. So they said, during the first year, we'll pay off your mortgage and give you a certain amount, but some of it's going to be retained for the following year, then you get to borrow the rest. And I kind of appreciate that because I had a client whose business was going out of business, and mom was more than willing to give him all her equity, but with this provision, it really wasn't feasible for her to do that. So,
Any other questions on this side? Sir?
I think Mark said that at a $1.3 million when you appraisal, that you only get about $408,000 of the reverse mortgage, which is like less than 1/3. Is that correct? I mean, you mentioned a few years ago it was 75%. This is less than 33%.
So yeah, that's because depending on the age, so someone older could borrow more, but I showed that 1.3 example to kind of show you the benefit of the jumbo. But with the FHA, even if your house is worth $2 million, you're only getting the benefit or consideration of a home worth $1,089,000. So then you get a percentage of that.
What about less than $1 million?
So it depends on the age. So if a person's 72, you're probably going to get about 45% of the $1,089,000.
Yeah. And again, if anyone here wants to have a consultation with Marty, with Martha, with myself, and really dig into this and kind of talk about your specific situation and needs, then, all their goodies are in the back. And as always, we send out our email follow-ups, and you'll have all their contact information as well.
Yeah.
So, questions over here?
Marty or Martha, is Mutual or anybody else, excuse me, offering an option on not paying mortgage insurance?
The jumbo reverse mortgage has no mortgage insurance. The lender will end up taking a loss in the end, but the interest rate is much higher to mitigate that risk. So yes, you can look, there's probably 3 lenders nationwide that offer a jumbo reverse mortgage.
Any other questions over here? Anyone? No? All right. Well, then it's that
That's
time.
pretty good, Dayna.
Yeah, that's pretty good. We're going to get you out on time this month. It's amazing. Let's do a little raffle drawing. You want to bring it up, and then we'll do a quick drawing and get you on your way for the day.
Just mention again, some of you
Hang-
may not want to ask a question here. We've got our cards out there that you can give us a call or email us, and we'll respond back with an answer for your question. So we'll be glad to meet with you and go through this again, give you a tailored proposal as well. So don't be bashful. We'll be glad to help you out in any way possible.